Hello everyone, a very good morning to you all. Welcome to the second lecture of Advanced Financial Management paper of ACCA. I hope all of you are doing well. We're going to start off from where we left yesterday, and that is chapter number 1. So, in our previous class, we were talking about the last topic that we talked about was communication to the stakeholders, wherein what are the different things we should keep in mind when we are communicating to the stakeholders, beginning with internal versus external, whether they are internal stakeholders or external stakeholders. The power and interest ranking of these stakeholders. For this, I explained to you the Mendelow's matrix. Then communication purpose, like what is the reason that we're communicating with the stakeholders and what is the appropriate medium for that communication. Next, we move on to a very important concept called agency theory. So, agency theory, to understand this, think in your mind whose money gets invested while running a company. Whose money is invested in running a company? Tell me, whose money gets invested in running a company? Shareholders? You're right, Deepak. And who runs the company? Who runs the company? Is it the shareholder or the directors? The directors run the company. Top, or you can say the directors overall, they are responsible for running the company, right? So what happens is the interests of shareholders could be different from the interests of the directors. And that gives birth to the concept of agency theory. Okay, now with that in mind, let's read from here. Agency theory studies conflicts between owners, managers, shareholders or management, and debt or equity holders, along with conflicts in management employee dynamics. So, I gave you the example of one of the agency theory, agency conflicts, and that is between the directors and the shareholders. There can be conflicts between the employees and the management also, senior management. Then there could be conflicts between debt providers and equity providers. So the different stakeholders that we talked about, and these are all important stakeholders, they can have conflicting requirements from the company. So that is what leads to the study of relationships between them. So principal, who has invested the money? Shareholders. Directors are acting on behalf of the shareholders, right? So what is the responsibility of the agent? The responsibility of agent is to generate maximum return for the shareholders. Okay? Then there is a relationship, conflicting relationship between directors and employees. And employees are acting on behalf of directors. When we are working in companies, we are executing our duties on behalf of the directors. So, what is the responsibility of the agent, which are employees? It is to work to maximum efficiency. Okay, what is it? To work to maximum efficiency. Then, similarly, there can be a conflicting relationship between debt and shareholders. Debt loan creditors are the principal who are providing money to the company of the shareholders, which is formed by the shareholders. So, here shareholders become the agent, and the responsibility of the agent is minimum risk from uses of borrowed funds. So, what they have to ensure is that there is minimum risk when it comes to the capital put in by the debt providers. So, this is the principal agent relationship. A company is essentially a collection of contracts among various interest groups. Success hinges on meeting the interests of each group to a satisfactory level. Okay, So that is about agency theory. So what have we studied? That the interests of uh, stakeholders could be conflicting. So in that case, the agent has to perform their responsibility. And what is their responsibility? When the directors are doing their duty, they have to keep in mind that they have to generate maximum return for the shareholders. When employees are working, they have to keep in mind that they're working to the maximum efficiency. When shareholders take money from the creditors, then they have to ensure that there is minimum risk to that capital. Okay. Now let's study something further about the stakeholders. Companies consist of diverse stakeholder groups with varied interests and objectives. Examples include for directors, what do they look out for when they are working? What is their interest in the company? They want a remuneration. So, what are we studying? We are studying the groups, different stakeholder groups, and what are their interests and objectives in the company. So, what is the interest of the directors? Remuneration, power and esteem, that they have sufficient power to execute, and job security. When it comes to shareholders, what do they want from the company? That their wealth gets maximized. Then, when it comes to the employees of the company, what do they want? They want pay and conditions, good working conditions, and job security. When it comes to customers, what do they want? They want the best product and best service. When it comes to the loan creditors, what do they want? They want a good security. Okay, that their debt is secured, maybe against land and building or plant and machinery. They want regular and consistent cash flows against their debt. That means what? The interest on debt should be serviced timely. And long term prospects, that their money remains invested for a long term. Whenever they want, or as per the terms of the loan, they get their money back. When it comes to the creditors, what do they want? They want their cash flow on time, that you are making payment to your suppliers on time. Then community, what do the community want from the company? They want that there are no environmental issues, everything goes well, and their environment is preserved. So, yes, shareholders are the most important stakeholder of the company, but along with shareholders, modern corporate governance emphasizes directors' responsibility to a broader spectrum of stakeholders. So you are not just responsible towards the shareholders, but you are also responsible towards other stakeholders. Directors are expected to demonstrate responsibility towards who all? All of these different stakeholders, other than the shareholders like creditors, employees, customers, and society. So creditors, they have to ensure that the terms of payment are reasonable and that they get the cash flows on time, as we discussed here. Employees, they get their remuneration and they get good working conditions in the form of health and safety prioritization. To customers, they are providing reliable goods and services at fair prices. To society, minimizing pollution and investing in social projects aligned with corporate social responsibility and reflected in ESG, ethical, social, and governance, sometimes also called environmental, social, and governance. Okay. Metrics like Dow Jones Sustainability Index and FTSE4 Good Index series. So these are some series metrics for measuring the performance towards ESG. ESG has become a really good topic among the corporates. They have been like once there was CSR and now it has transitioned to ESG. We will study more about ESG in our curriculum also. And very recently, we did a special lecture series on ESG with VGLD. So, seeing the growing importance of ESG, that's being factored into the curriculum also. All right. So, this approach may lead to a satisfying corporate objective. Can someone tell me as well. Satisficing corporate objective. No one remembers what happened. All right. I'll make you come to Excel. I'm asking, I mentioned about satisficing corporate objectives yesterday in the class. Do you remember what it is? So we talked about, I'll just summarize it for you of some key topics. We talked about strategy yesterday. So what is a strategy? I'm just summarizing this important discussion here in Excel also. A strategy A strategy is an action plan to achieve an objective which could be varying in duration. That means strategy could be long term, oblique medium term, oblique short term. Corporate strategies. So then strategy can be broadly classified. Can be broadly classified into two parts. First is corporate strategy. First is corporate strategy. So corporate objectives I can call strategies can be plan for pursuing two types of objectives. Corporate objectives. Corporate objectives pertain to the entire organization and often encompass a range of goals, such as we discussed these profit targets, then market share goals. I gave you the example of Panorica's recent market leader position. Then share price growth, addressing local and environmental concerns. Here I gave you some examples from Coca-Cola. Then maintaining a contented workforce, that you keep your employees satisfied so that the attrition rate is lower. Okay, so these are the types of corporate objectives that we talked about. Okay. Now these objectives, broadly, these objectives can be categorized as follows. It's important, please understand it carefully. We discussed this yesterday, I'm repeating it. So these objectives can be categorized as follows. First is what? Profit goals. Profit goals are the ones which aim to directly enhance profits of the company, such as cost reduction measures. Okay, such as cost reduction measures. Second is surrogate profit goals. Surrogate profit goals. They indirectly contribute to increased profits. Like if you have you're maintaining a contented workforce, then you get surrogate profit, indirect profits. Then the goals or the objectives which we have discussed above could be placing constraints on profit, like you have to contribute towards the environment. So there can be goals or corporate objectives which put constraints on profit. So objectives that limit profit, such as ensuring operations do not harm the environment. Then the goals could be dysfunctional also, that you are pursuing market leadership at any cost. So this is what we discussed about the types of objectives. And here I introduce the term of satisficing objectives. Okay. So these objectives which we have talked about, they can be classified under one of these. So a company, so these are the objectives, and the company may have the following two types of approach towards achieving these. So a company may pursue either, please remember these terms, maximizing or satisficing these objectives. Now, what does it mean? Maximizing means that you are aiming to simply increase your profit. Can you give me an example of a company which is focused on increasing its profits? You can say Reliance. So it aims for the best possible outcome in achieving objectives, right? And satisfying, a company's approach to achieving the objective, if it is satisfying, it means that they seek an adequate outcome that meets the objectives without necessarily optimizing the best possible results. That means they are contributing not just towards profits of the company, but also towards uplifting the society and the other stakeholders. Can you tell me an example? I gave it to you yesterday. No, we talked about Tata Group here, that you're achieving adequate outcome, but you are not necessarily prioritizing profits because the Tata Group does a lot of philanthropic work. Okay, that's a perfect example of pursuing a satisfying approach towards objectives. Okay, and then I'll just mention about the other one. So these are the corporate objectives, and then we have the financial objectives. Financial objectives. So, what are the metrics for financial objectives? Very easy to, and this will be much more relatable, including EPS, EPS, then dividend per share, then gearing level, which is basically your debt to equity ratio, and operating profitability. So these are the financial objectives. These are the corporate objectives as they affect the entire organization. This is what the financial objectives of an organization are, and they are different from corporate objective metrics you can see above. Okay, so this is a very important discussion on the type of strategy and the different approaches a company can follow. On that note, now let's come back to where we were and where this term got introduced. So this approach, I'm sure now you'll be able to relate to it better. This approach may lead to a satisfying corporate objective when you're taking care of the concerns of all the different types of stakeholders. That means you're trying to achieve a satisfying corporate objective. Are you able to understand this now? Emphasizing satisfactory returns. So satisfying corporate objectives are they provide satisfactory returns for the stakeholders rather than maximizing them. Okay. So with the emergence of ethical investors globally, shareholders seem willing to accept slightly lower returns. So shareholders are also today okay with accepting slightly lower returns in exchange for companies pursuing a broader range of both financial and non-financial objectives. Please tell me, are you able to understand this? These topics, they are important for addressing theory questions. This entire discussion which I did with you on how a strategy is categorized and how today the companies are moving slowly from maximizing the corporate objectives to satisfying corporate objectives. That means they are providing satisfactory returns to the shareholders while keeping the interests of the other stakeholders also in mind. Take 2 minutes, observe it, let me know if it's fine, then I'll move to the next part. Let me know if it's fine, then I'll move to the next topic. Is it okay? All right. All right. So, investing and financing impact on stakeholders. So, what you have to carry in your mind is now that it's not just about maximizing the wealth of the shareholders, but it is about having satisfying corporate objectives where you keep the interest of different stakeholders in mind. So, ESG performance. Strong ESG principles enhance performance, credit ratings, and crisis resilience. When you have a strong ESG, what is ESG? Ethical, social, and governance metrics. Sometimes you will find it as environmental, social, governance practices. So both of them are they are fine. So strong ESG principles enhance performance, credit ratings, and crisis resilience. Stakeholder focused advantage. Serving stakeholders is a competitive advantage, especially during crisis. You would have seen that a lot of companies they flourish just because they are good in providing services to the customers. So they are treating not just shareholders as important stakeholders, but also customers. And these companies they are able to flourish even in the difficult times. Employee management. Increasing wages and offering scholarships or apprenticeships boosts engagement and reduces turnover costs. And next, risk management. Addressing government government intervention risks. Okay. So aligning the goals with the stakeholders, like sharing expertise with suppliers, so drives higher returns and protects the shareholder value. So when you're trying to create a common goal with the different stakeholders, it helps in driving higher returns and protect the shareholder value, right? So when you are understanding the impact on the stakeholders, you have to keep in mind that there could be following aspects that may affect the impact that you're creating on the stakeholders. Number one is how strong your ESG principles are, how focused you are on upkeeping the interests of different stakeholders, how well you manage the employees, how well you are able to merge the goals with the different stakeholders, therefore managing the risk around them. Okay. Now let's take a look at Reliance and its different stakeholders. RIL, India's largest conglomerate by market capitalization, boasts a vast and diverse range of stakeholders. Understanding these stakeholders and their interests is crucial for analyzing RIL's success and potential challenges. Let's delve into some key groups. Shareholders, primarily individual investors and institutional investors like mutual funds and foreign portfolio investors, they seek long-term capital appreciation through dividends and stock price growth. So that is what shareholders want from the company, from RIL. RIL employs over 230,000 people across its various ventures. Their focus lies on job security. What do they want from the company? They want job security, competitive salaries and benefits, and career growth opportunities. So, employees who are working in RIL, this is what they're wanting. Then, customers. RIL caters to a vast customer base through its diverse businesses, including petrochemicals, telecom, retail, and media. So, customer satisfaction with product quality, affordability, and service standards is paramount for these for the customers, that they are satisfied, they are getting affordable products, and the service standards are maintained. Next, suppliers. So, a network of thousands of domestic and international suppliers provide raw materials, equipment, and services to RIL. So, what do they want from the company? Timely payments, fair pricing, and long term partnerships are crucial for their well being. Then, local communities. RIL operates in many parts of India, impacting local communities through its operations and social responsibility initiatives. Okay, so RIL has been fundamental in servicing the local communities. Also, they are also engaged in a lot of CSR activities. So, environmental concerns, employment opportunities, and community development projects are key areas of interest for these stakeholders. Then, government RIL interacts with various government agencies at local, state, and national levels for regulatory approvals, tax compliance, and policy frameworks. So while dealing with the government, they want to have smooth relationship and government wants adherence to the regulations. Then environmental groups. RIL's petrochemical and refining business raise environmental concerns for some groups. So sustainable practices, this is what they want. The environmental activists, what do they want? Sustainable practices, waste is managed properly. So maybe a proper sewage treatment plant, effluent treatment plant. Okay, so they are set up in the factories and transparent environmental assessments. These are critical points of engagement for these environmental groups. The media and analysts, public perception and investor confidence are heavily influenced by the media coverage and analyst reports. So, what does media want from Reliance? They want to have an open communication, financial transparency, and addressing social concerns responsibly are vital for navigating the media landscape. So, these are just some of the many stakeholders involved with RIL. Understanding their varied interests and ensuring a balance between their needs is a complex but crucial task for RIL's management. By successfully navigating this multifaceted system, RIL can continue to thrive and contribute to India's economic growth. Okay, so if they're able to manage the different stakeholders properly, then of course the company can keep growing. And that is the charm of the big companies, that they know how to manage the different stakeholders and keep everyone happy. Very recently, I was seeing some posts on Zepto. Have you seen that? Anyone who's following? So, one of the employees anonymously revealed that the work culture in Zepto is very much, it's not good. The founders, they start their work at 2 p.m. in the, afternoon, and then they hold the meetings until late 2 a.m. And anytime the meetings are rescheduled, postponed, and the work culture is not good. And it just throws limelight on what goes on in these new age companies. And this is where you would have seen Baiju's faltering. You all would be aware how Baiju's has gone down the hill, right? So this is a clear indication that although you may be providing satisfactory returns to the shareholders, if you do not provide adequate service, I would say, or satisfying their objectives, other objectives of other stakeholders, you may not be sustainable in the long run anymore. Because the different stakeholders, they have garnered a lot of power over time, and if you try to overpower them, you're just in for a toss. You have to keep everyone happy, and that is what is seen in these traditional companies, that they know how to manage the different types of stakeholders. All right. Now we talked about agency theory briefly before, and now we will deep dive into it. So first we talk about directors and shareholders, the agency issue between them. In larger companies, directors, separate from shareholders, manage the company and are duty bound to promote its success. They must act in good faith, considering consequences for all stakeholders. And directors may have personal objectives, including increasing personal remuneration, maximizing bonus payments, pursuing empire building, and ensuring job security. So that this is what directors have, as personal objectives, that they want higher and higher remuneration, they want higher bonus, then they want job security. So beyond personal objectives, a few directors have breached their duty through creative accounting. Using creative accounting policies to enhance or window dress the accounts, then hidden corporate activity, concealing corporate activities, for example, through the use of special purpose vehicles, the companies, they may set up some shadow entities to do some other activities. Then takeovers. Some directors defend companies from takeovers accused of prioritizing job protection because they want to protect their own job over the shareholder interest, whereas the takeover might have been beneficial for the company. But directors, since they want to prioritize their own personal objective, which is ensuring job security, the directors may have ignored or may have rejected the proposal of takeovers. So this has been observed in the past. And then environmental disregard, allowing processes emitting pollution or testing products on animals, indicating a disregard for environmental issues. Okay, so this is where the agency issue arises. Ideally, yes, the directors are acting on behalf of the shareholders, and their objective should only be maximizing the wealth of the shareholders. However, there have been instances when the directors have been found to working to prioritize their personal objectives that we have discussed here, like personal remuneration or bonus payments, pursuing empire building. Empire building meaning that they create empires through many acquisitions, although it may not be good for the company's shareholders. So, agency costs. Directors pursuing personal objectives conflicting with shareholders result in agency costs, termed the agency problem, leading to potential lost returns for shareholders. Corporate governance is the system directing and controlling companies. Okay, so implementing a good corporate governance is crucial to minimize agency cost. So, how the directors are directing and controlling companies, that gets analyzed under corporate governance. So, however, the introduction of corporate governance, including the Sarbanes-Oxley Act, it comes in with its own cost. So therefore, a cost-benefit approach should guide the determination of an appropriate level of control over directors. So what is agency cost? The cost, it's not like any physical money outflow, but the cost which is incurred because the directors are not acting in the best interest of the shareholders. That is what agency cost is. So most shares in listed companies are held by institutional investors, yet some fund managers operate passively, neglecting even their proxy voting rights. So without increased shareholder activism, certain directors may continue prioritizing personal interests over those of the shareholders. So what it is trying to say is that the interests of the directors, they conflict with those of the shareholders. Okay, that leads to agency costs. There can be problems because of that. So the actual return to the shareholders is said to be the maximum potential return minus the agency costs. What is corporate governance? A system which is in place to ensure that shareholders are the interests of the shareholders are preserved. So a lot of systems are put in place, a lot of policies and practices are set across an organization. So it is ensured that the employees and the directors are working towards maintaining a compliant environment which upholds the interests of the shareholders. Now let's understand this with an example. So one prominent example of an agency issue between directors and shareholders in India involved the Tata Group and its former chairman, Cyrus Mistry. The Tata Group is a sprawling conglomerate with interests in diverse sectors like automobiles, steel, IT, and hospitality. Cyrus Mistry was appointed chairman in 2012, the first non-Tata to hold the position in its over 150-year history. In 2016, Mistry was abruptly removed from his position. He subsequently alleged several instances of mismanagement and poor corporate governance under the board of directors, including decisions taken without proper board consultation, high debt levels and questionable capital allocation, lack of transparency and accountability, favoring certain businesses within the group at the expense of others. So, this type of concerns were raised. Mistry argued that these actions were detrimental to shareholder value. So, he said that the corporate governance system in Tata Group is not optimal. The directors are not acting in the best interest of the shareholders. This is what his prime highlight was, and then a lot of chaos followed. So that these actions were detrimental to shareholder value and constituted a breach of fiduciary duty. What you should do ideally, fiduciary duty is what the directors should do ideally. Okay. So what was the shareholder response? The shareholder response to Mistry's allegations was divided. Some institutional investors and minority shareholder expressed concern about the governance issues raised. However, the Tata family, which holds a majority stake in the group, backed the board. So Mistry had raised concerns over the board that the board is not acting in the best interest, whereas Tata family, who are holding the majority stake in the Tata group, they backed the board. So in 2019, the National Company Law Appellate Tribunal ruled in favor of Mistry, finding that his removal was illegal and unfair. However, the Supreme Court later overturned his decision, upholding the board's action. So, what does it highlight? This case brought several agency issues to light, like concentration of power in the hands of the controlling shareholder, the Tata family, weak shareholder voice, especially for minority shareholders, then lack of transparency and accountability in decision making, and potential for conflicts of interest between directors and majority shareholders. Sometime it can happen. So the impact was the Tata Mistry dispute served as a reminder of the importance of good corporate governance and shareholder protection in India. It also led to some reforms in the legal framework regarding minority shareholder rights and board accountability. This example is actually perfect for agency costs. You understand that the company would have suffered a lot of costs in terms of due to the conflict between Mr. Cyrus Mistry and the board because of the allegations that they are not acting in the best interest of the shareholders. So these are indirect costs. As I told you, it's not a direct cost that is incurred, it's an indirect cost. It could be reputational damage, it could be legal costs also, it could be loss of sales because of the ongoing chaos. So these are the indirect costs. Agency costs are the indirect costs which are incurred because the shareholders they are not getting the best possible returns due to directors not acting in their best capacity. So what can be done to overcome the agency costs or agency conflicts? Goal congruence. So what does it mean? Alignment of stakeholders' interests with the overall best interests of the company. So you align the interests of directors with that of the shareholders. Okay, so we learn how it is done. Example, encouraging managers to prioritize long-term growth ensures both shareholder wealth maximization and job security. Okay, so what are the methods of encouraging goal congruence? Goal congruence between directors and shareholders. It can be encouraged through. How can you ensure goal congruence? Number one is ESOPs. Do you know what ESOPs are? Anyone? Do you know what ESOPs are? So employee stock option plan is the full form. What it means that employees are given options to convert their, to become shareholders of the company sometime in future if they complete some number of years of service. Okay. So that is ESOPs. And when you give employees or directors ESOPs, they are also interested in increasing or maximizing the shareholder wealth through the increase in share price, because their remuneration is also encompassing ESOPs, which are options to convert into the shares of the company. So ESOPs align the interests of directors and shareholders through rising share price, although success varies due to market fluctuations. Then another way in which you can align the goals between the directors and the shareholders is through long-term incentive plans, providing bonuses to directors based on sustained company performance against the competitors over several years. Then transparency in corporate reporting, enhancing openness in reporting practices. Okay, so you are quite open about whatever activities you are doing as directors, and that provides transparency for the shareholders. Then improved corporate governance, incorporating truly independent non-executive directors to enhance the governance, because non-executive directors, their remuneration is not dependent on the company's performance at all. They are paid a fixed fees, so they ensure that the directors are doing their duties properly. The executive directors are doing their duties properly. Then increased shareholder activism, empowering shareholders through voting rights to influence corporate decisions. So these are the ways in which the goals of the directors and shareholders can be aligned. Please go through this topic, have a look. Let me know if it is fine. Is it okay? All the points that we have covered? All right. So some ethical context for the financial executive or advisors. So some context which should be kept in mind. So what are the main principles? As a financial advisor or executive in a company, you should act with integrity, because the compliance of policies is in your hands. The governance, creating a governance environment and maintaining it is in your hands. So you have to act with integrity. Be a credit to the profession. So you are doing what you are taking up is a prestigious qualification, and people look up to the qualified accountants with a lot of dignity. So you have to maintain that. So be a credit to the profession. Use independent professional judgment and be competent. Once in a while, pick up a finance journal and revise your concepts, because people, they expect that if you are an accountant once, if you are a professional accountant once, you are up to that level all the time, so you don't let your expertise diminish with time. So that is the principle which is looked out for in finance professionals. So what are the fundamental responsibilities? A senior financial executive or advisor should know and comply and avoid violations. That means A financial advisor should be knowledgeable and adhere to laws, regulations, ethical codes, and professional standards. And they should avoid violations, refrain from knowingly participating or assisting others in any violation of applicable regulations or ethical codes. Okay, so these are the fundamental responsibilities. Now, relationships with the profession. A senior financial executive or advisor should employ the ACCA designation with dignity. As I told you, people look up to the professional accountants with a lot of respect and dignity, and that should be maintained. And refrain from engaging in any act that adversely reflects on one's honesty, trustworthiness, or professional competence. So, next, very simple point. So, going a little, I mean, I hope it's understandable. Let me know if you need any further clarity. Relationship with the employer. Professional accountants must compete with consent. So, you should obtain employer and client consent before engaging in independent practice that competes with their employer. Transparent disclosure. Disclose to their employer any factors that could reasonably compromise their ability to provide unbiased opinions. That means if you are providing your services in a company in which you have a family member on board, then it should be revealed and there should be transparency. You are expected to do the bare minimum. Then, full disclosure of benefits. Inform their employer about all monetary and non monetary benefits received for services beyond their primary employment compensation. So, if you're receiving anything other than your primary salary, then it should be informed to the employer. Then, interaction with clients. So, professional accountants must prioritize the interests of their clients over their own. So, when you are dealing with clients, you should keep or uphold the client's interests. Then, you should provide opinions based on reasonable and sufficient foundation. It should not be something intuitive that I feel this, therefore, you should do it. No, your opinions should be based on a reasonable and sufficient foundation and exercise reasonable judgment. So you employ reasonable judgment by including pertinent facts, distinguishing between fact and opinion, and maintaining independence and objectivity in forming opinions. So that is your role when you are dealing with the clients. Okay. So that is about the ethical context for financial executive or advisors. These are the main principles which guide your relationships with different entities like the profession, the employer, and the clients. So it's more like your responsibilities being a professional accountant. I hope it is good to go ahead. Let me know. Let me know if you have any doubt. All good? Okay. So moving on. Now, compliance with anti-money laundering legislation. Now, before we get into this topic in detail, I want you to watch some videos. Play that.
It's often done.
So I'm going to play this video. Please look at it carefully. It's a very interesting video. And it explains the concept of money laundering. And after we have seen these videos, we'll go to the concept of anti-money laundering.
As one of the most notorious gangsters in history, Al Capone presided over a vast and profitable empire of organized crime. But when he was finally put on trial, the most he could be convicted of was tax evasion. The nearly $100 million a year, that's 1.4 billion in today's currency, that Capone had earned from illegal gambling, bootlegging, brothels, and extortion would have served as evidence of his crimes. But the money was nowhere to be found. Capone and his associates had hidden it through investments in various businesses whose ultimate ownership couldn't be proven, like cash-only laundromats. In fact, those laundromats are part of the reason for the name of this activity, money laundering. Money laundering came to be the term for any process that cleans illegally obtained funds of their dirty criminal origins, allowing them to be used within the legal economy. But Capone wasn't the first to launder money. In fact, this practice is about as old as money itself. Merchants hid their riches from tax collectors, and pirates sought to sell their bounty without drawing attention to how they got it. With the recent arrival of virtual currencies, offshore banking, the dark net, and global markets, schemes have become much more complex. Although modern money laundering methods vary greatly, most share three basic steps: placement, layering, and integration. Placement is where illegally obtained money is converted into assets that seem legitimate. That's often done by depositing funds into a bank account registered to an anonymous corporation or a professional middleman. This step is where criminals are often most vulnerable to detection, since they introduce massive wealth into the financial system seemingly out of nowhere. The second step, layering, involves using multiple transactions to further distance the funds from their origin. This can take the form of transfers between multiple accounts or the purchase of tradable property like expensive cars, artwork, and real estate. Casinos, where large sums of money change hands every second, are also popular venues for layering. A money launderer may have their gambling balance made available at a casino chain's locations in other countries or work with employees to rig games. The last step, integration, allows clean money to re-enter the mainstream economy and to benefit the original criminal. They might invest it into a legal business, claim payment by producing fake invoices, or even start a bogus charity, placing themselves on the board of directors with an exorbitant salary. Money laundering itself wasn't officially recognized as a federal crime in the United States until 1986. Before that point, the government needed to prosecute a related crime, like tax evasion. From 1986 on, they could confiscate wealth simply by demonstrating that concealment had occurred, which had a positive effect on prosecuting major criminal operations like drug traffickers. However, the legal shift has raised concerns involving privacy and government surveillance. Today, the United Nations, national governments, and various non-profits fight against money laundering, yet the practice continues to play a major role in global crime. And the most high-profile instances of money laundering have involved not just private individuals, but major financial institutions and government officials. No one knows for sure the total amount of money that's laundered on a yearly basis, but some organizations estimate it to be in the hundreds of billions of dollars.
So it was a very interesting video. So what are the 3 steps involved in money laundering? Tell me. What did you learn from the video? What are the 3 steps? Tell me. Did you watch the video carefully? What happened? Are you all there? First one was layering, then placement, and then integration. Okay, so that's how money laundering works and how it has developed. I mean, the prosecution of money laundering has developed, that we covered in this video. I've got one more very interesting video. Let's have a look at it. And everyone, please do watch it. Sorry, my bad. I think I said layering first. Placement, layering, and integration. So have a look at this video. This is also very interesting. Okay, so again, very interesting video on how a money laundering scam happened in the Britain. Now, moving on to the topic that we have here is compliance with anti-money laundering legislation. So, if we understood about the activities which comprise money laundering, and now let's understand. So, money laundering has a broad definition covering activities tied to the movement of money or assets from illegal endeavors, ranging from terrorism to tax evasion, depending on the jurisdiction. This encompasses actions like facilitating financial transactions, creating offshore accounts, registering companies, and distorting financial information associated with unlawful activities. So it's crucial to note that even those not directly benefiting from money laundering can be held liable for offenses. So you may not even be aware that you have become a part of a money laundering scam. Also, anti money laundering compliance. Typically, the law designates entities involved in regulated activities such as banks, high value property transactions, and accountants to follow detailed AML procedures supervised by bodies like ACCA. However, AML legislation generally applies to all businesses, mandating the reporting of suspicious transactions to the relevant authority without notifying the client. Okay, so determining a client's potential involvement in money laundering requires a risk based approach involving risk identification, identifying, describing, and evaluating risks associated with money laundering. So, you as a professional accountant have to perform some steps to understand whether there has been some involvement in money laundering or not. So, you identify, describe, and evaluate risks which are associated with money laundering. Controls and procedures. Implementing controls and procedures, including KYC. You would have heard so much about KYC requirements, right? So, why is it done? So that the money can be traced back to some entity. So, implementing controls and procedures, including KYC requirements, internal reporting for suspicious transactions, and fostering a reporting culture. The banks have a very stringent KYC norms, okay, which they have to follow, and they have to report suspicious transactions to the relevant authorities. So, monitoring and documentation, monitoring controls through documentation, regular review, and recording the actions taken. And staff training and adaptation, training staff in systems and controls, adapting them based on experience and environmental changes. So, banks and legal firms require robust proof of identity from new clients and often demand evidence like bank statements and sale documents for the source of substantial funds. So, they'll ask for your bank statements to understand whether the money that you're using is clean money or laundered money. Okay. So moving on, international. So we take a look at this example of HDFC Bank. It's a leading private sector bank in India known for rigorous KYC and AML procedures. It employs advanced data analytics and fraud detection systems to identify suspicious transactions. Regularly conducts AML training for employees and maintains transparent reporting of suspicious activities to the Financial Intelligence Unit. It has even received recognition from prestigious bodies like Euromoney for its exceptional AML compliance practices. So, the authorities have placed importance on banks and financial institutions to ensure compliance with the AML regulations. And that is why you have to reveal your PAN. Let's say if you're depositing more than 50,000 rupees in a bank, you have to reveal the PAN, right? So these types of practices have been set up by the banks to ensure that money is traceable. That's about, that's the whole agenda of AML, that you're able to trace money to some source. If that is okay, then the money is considered clean. Otherwise, there is some sort of money laundering happening. So businesses operating overseas may confront specific ethical issues, prompting consideration of facilitation payments, deciding whether to make payments to local officials for overcoming. One second. Yeah, so businesses operating overseas may confront specific ethical issues, prompting consideration of facilitation payments. That is, deciding whether to make payments to local officials for overcoming bureaucratic hurdles like custom clearance. Another word for bribe. What they're saying, read it again with me. So, businesses operating overseas may confront specific ethical issues. When you are doing that, please consider whether payments to local officials for overcoming bureaucratic hurdles, if you're making that, then it can become a part of money laundering activity. And transfer pricing, addressing the acceptability of using international transfer pricing strategies to minimize tax liabilities. Then offshore asset transfers, deciding whether to transfer assets into offshore companies to mitigate capital gains tax on disposal. Then compliance with local laws, determining whether to adhere to more relaxed overseas laws like child labor or uphold the business practices of the home country. Then sensitivity to local business practices, recognizing and respecting local customs such as adhering to Sharia law in the Islamic world, which prohibits interest payments and investment in certain activities. We are going to learn about a lot of Islamic finance instruments. So, when you are dealing internationally, you have to be careful about these aspects. You have to be aware about the local laws around these points. Otherwise, you may get caught up in some sort of illegal activity without having even an intention to do so. Okay, so very recently, Adani came into the limelight that for bribing the government officials here. So Adani is into international operations. So although the allegation was for bribing the officials in India, but still there was so much international scrutiny why the money was raised in US. Okay, so you have to be very careful. Otherwise, you may just end up being in a jail. Okay, so you have to decide whether the facilitation payments, if they are in the nature of bribes or the transfer pricing norms that you are setting up, is that to evade tax or is it to manage tax? Okay, because tax evasion is not allowed. But if it is just some way to manage taxation or something, then that's still okay. So you have to be very careful when you're setting up the transfer price. Then if you're doing any offshore asset transfers, that means international asset transfers, then that also is scrutinized very closely. I'm sure you're aware that any international asset holding is also to be revealed in Indian tax returns. So why is it so that it can be traced? It's not illegal to hold property, but if you are engaging in some transfer which is illegal, then it gets caught. And that's the whole objective of requiring the disclosure of such properties in the Indian tax returns also. In compliance with local laws, you have to be aware of the laws. You cannot say that, okay, I was not aware that I can use child labor or not in my work. That's not possible. Your arguments will not be tenable in a court of law. And then sensitivity to local business practices. You should be aware how locals conduct their business. Okay. So very recently, I don't remember who it was. Just not related to business. Who was it? I was watching. I'm forgetting. So there was some famous foreign personality, and he had said that, when I came to India, I realized that using elbows to move across in crowds is a norm here. And it was some interview that I was watching. I can't recall who it was. He was saying this. So just I mean, it's not a business practice, but I'm just saying, so look, every country has its own practices, and even when it comes to business, there are some practices that you should be aware of when you are dealing internationally, and so that you are not non-compliant. Okay, so like if you are in Islamic countries, it prohibits interest. Okay, Sharia law prohibits interest. So we're going to learn about that later. But yes, you have to be aware about it. Okay, so these are the international aspects which should be considered. Now comes ethical decision making. It's newly added in the syllabus, so we'll be covering this now. Various models exist to classify and describe moral and ethical decision making, including REST's four component model, Albright's ethical development model, and IAESP ethics education framework. So let's go with REST's model first. So this four component model, you have to memorize these things, because if it comes, then you have to repeat it. Like in the way, what are the steps in the component model? You can't just write general things. You have to be specific here when it comes to models. So the first step is, it must be recognized that there is a moral issue involved. I think, one second. So let's come to Excel to understand this better. I'll try to break it down with some examples for you. So what is the 4-component model? So REST's 4-component model is a framework for ethical decision making that outlines 4 psychological processes individuals need to navigate to make and implement ethical decisions effectively. Each component is essential, okay, and weaknesses in any step can lead to ethical lapses. So the first step is moral sensitivity. First step is moral sensitivity. This is the ability to recognize I can write it here for you. So this is the ability to recognize that a situation involves ethical issues and that one's actions can affect others. It requires awareness of how decisions impact others' welfare, rights, and fairness. Okay, so for example, a manager in a company notices that a team member is being unfairly excluded from important meetings. So, recognizing this as an ethical issue involves moral sensitivity. So, you're recognizing that something is not being done ethically. Okay. The next is moral judgment. Second step is moral judgment. So, this step involves reasoning about what ought to be done in a given situation. It requires understanding ethical principles and weighing different options to arrive at a morally justifiable decision. Okay, so here, continuing with the example. Example. The manager considers the possible actions. Confronting the colleagues, excluding the team member. Who are excluding the team member? They are confronted. Then reporting the behavior to HR and ignoring the issue, deciding this is unethical. Okay, so here are the following 3 options that he can do. First is he could confront the colleagues or report the behavior or do nothing about it. Okay, so the following actions. So they conclude that fairness demands addressing the exclusion directly with the team. So they feel, the manager feels that he concludes that the fairness demands addressing the exclusion directly with the team. So this is an example of a moral judgment that has been taken. Now, next step So you're taking a decision in this step. Further, step number 3 is moral motivation. Okay. Moral motivation. Moral motivation refers to prioritizing ethical values over personal or organizational gains when faced with conflicting interests. It ensures one's commitment to doing what is right despite potential obstacles. Okay, so example here. The manager might face pressure from peers or fear creating tension with the team. So there is this fear that, okay, if it will create some conflicts. However, he prioritizes fairness and inclusivity over maintaining the status quo. So he does not want these things to go as if he wants to prioritize fairness, which is an ethical value. It's not personal, it's not organizational gain, it is the ethical value of fairness that he is considering. Then, step 4 is moral character or implementation. So, this component focuses on taking action and following through the ethical decision. It requires courage, persistence, and interpersonal skills to implement the decision, especially when faced with challenges. For example, so the manager organizes a meeting with the colleagues involved and the excluded team member. He explains the importance. He explains the importance of inclusivity and set expectations for future behavior, ensuring the team member is included going forward. So this is the 4-step RESTS model on how to take an ethical decision. Okay. Please go through it. I'll just zoom out a little, go through the steps. Go through the example. Let me know when you want me to scroll down. If you're able to see, if you're not able to see, let me know. In the point moral judgment, please explain point 1 of the example again. So the manager, he had the following 3 options that, following possible actions that he could have taken. First is he could go and confront the colleagues that why are you doing this? Why are you excluding this team member? So having a discussion with those colleagues. Second is he could have simply reported the behavior to HR. Third is he could have ignored. He could have ignored the issue thinking that, okay, he himself decided that it is unethical, but he did not do anything about it. So he ignored the issue. These are the 3 possible actions he had in hand. So he concludes, he takes the decision that fairness demands addressing the exclusion. That means you confront the colleagues who are excluding the team member. That's the decision which has been made. Able to understand now, Mansi? So he had three options that he could do, and he opted for the first one. Please go through it if you're able to understand. You want me to reframe. Okay. Does this help? All right. Everyone, please go through. Let me know if you want me to scroll down. I'll give you one more example just for understanding it better. All right, so let me give you one more example, one complete holistic example. This was stepwise. Now I'll give you one more example. I hope all of you are able to understand. Let me know if you have any doubt. I'm trying to simplify it with this example. Okay. So scenario is a pharmaceutical company. This is the scenario. A pharmaceutical company discovers that a new drug, a new medicine which they have developed, has side effects not disclosed during testing, which could harm patients. So this is happening in the company. Okay. So what will the four-step model require you to do? So as per the first step, moral sensitivity, the company recognizes that withholding this information is an ethical issue affecting patient safety and trust. Okay, this is, you're not upkeeping the patient safety and trust if you're not revealing it. So that is moral sensitivity. You are recognizing that. Then second is moral judgment. So you have to make a decision here. So moral judgment, the leadership evaluates three options. Okay, they have three options in hand. Publicly disclose the side effects, modify the drug before distribution, or proceed without disclosure. So they decide transparency and patient safety must come first. Okay, so they want to be transparent. So moral motivation. So moral motivation. Even though disclosure may lead to financial losses and damage to the company's reputation, they prioritize patient welfare and integrity. Okay. And last is your moral character. Here. So what do? The company issues a public statement about the side effects, halts production temporarily, and collaborates with regulators to address the issue. So this is one complete holistic example on the rest's four component model. Go through it if this is clear. Yes? All right.
Hey, how's it going? I'm looking for.
Everyone, please let me know if it's fine once you're confirmed. Good to go? All right. So let's move to the next part. So now let's understand it from here. This four component model is as follows. Step one, it must be recognized. Now you'll be able to relate to it better with the examples, two examples that we have covered in mind. Step one, it must be recognized that there is a moral issue involved. The decision maker must be able to appreciate that the selection of a particular course of action will affect the welfare of other interested parties. Step two, the decision maker must be able to select an appropriate action. So you'll have multiple courses of action available in front of you. You have to take a decision out of it. Step 3. The decision maker must attach priority to ethical values like fairness, we considered in one of the examples, rather than, for example, acting out of self-interest. Not personal interest, not organizational interest. You have to act in the best interest of moral values. Step 4. The decision maker must have sufficient moral strength to implement the resolution identified in the previous steps. So this is the 4-step model. Keep the examples in mind. You'll be able to relate to it better. Okay. Then next model that we have for ethical decision making is Albright's ethical development model. It also unfolds in 4 progressive levels. This also we'll discuss in Excel with some examples. So Albright's EDM, ethical development model, provides a framework for ethical decision making, emphasizing the progression of ethical awareness and actions across 4 levels. And what are they? Personal ethical understanding, application of ethics to business situations, ethical courage, and ethical leadership. It's okay. Once you go in the flow of the chapter, it will all become relatable. I can give the reference, but then I'll have to make a lot of amends. So you can just refer to the headings which I'm giving in colored. Okay. So this model highlights how individuals they grow from personal ethical awareness to influencing others in leadership roles. So it's your progression as a manager that how you grow from personal ethical awareness and end up influencing others in leadership roles. Okay. Now let us understand each one of these elements in detail. Keeping the layout same for you to understand better. So the first step that we have is personal ethical understanding. So this level focuses on individuals' recognition of fundamental ethical principles such as basic principles, honesty, fairness, respect, and integrity. So it involves understanding the difference between right and wrong on a personal level. That's your own personal values. Okay, how honest you are, how much integrity you have. So it's the personal ethical understanding. So example, a marketing professional realizes that exaggerating claims about a product in advertisements is dishonest and could mislead the consumers. This understanding stems from personal values of honesty and respect for others. Okay, so this is personal ethical understanding. Then, second step is application of ethics to business situations. At this stage, individuals apply their personal ethical understanding to specific business contexts. They navigate real world challenges by integrating. So at this stage, individuals apply their personal ethical understanding to specific business context. They navigate the real world challenges by integrating the ethical principles into business decisions and policies. Okay. So now let's continue with the marketing professional example. So let us say, I just change this example slightly to make it more specific to a situation. About a weight loss product. Okay. So there's a weight loss product which he is wanting to advertise, and this is honest and it could mislead the consumers. This is what is his personal value about it. Now, when the team suggests, okay, now example. While creating the ad, while creating the advertisement for the weight loss product, the marketing team, suggests using digitally altered images of success stories to enhance the product's appeal. Okay. However, the professional insists on using authentic testimonials and realistic claims. He explains that misleading advertisements could harm customers and damage the company's reputation. Are you able to follow? So while he was creating the advertisement for this weight loss product, the marketing, his team suggested that you should use digitally altered images to, of success stories. You might have seen also for hair growth products, for height growing products, for weight loss products, it really happens, right? So the team suggests that you should use digitally altered images. However, the professional insists on using authentic testimonials and realistic claims. He explains that misleading advertisements could harm the customers and damage the company's reputation. Okay. Then what is the next step? Let's understand that. Step number 3 is ethical courage. Ethical courage. Ethical courage is the ability to act on one's ethical beliefs even in the face of adversity, when everyone is confronting you, still pressure or personal risk. This level involves taking a stand against unethical practices and being willing to face potential negative consequences. So here, let's continue our example. Let's build this example further. What ethical courage will look like here. So the company's leadership pressures the professional to approve a campaign. Okay. So they are pressuring him to approve the campaign to meet the sales targets. Okay. Despite knowing it might jeopardize his relationship with the leadership or his career progression, the professional refuses to approve the campaign. Instead, he escalates the issue to the company's ethics committee or HR department to ensure ethical practices are maintained. So this is what he did. He showed courage. Everyone was against him. They were putting pressure on him to approve the campaign. But what he did, he took the stand that, okay, no, I'm not going to approve this. You have to reach out to the HR department or ethics department. Then next step. Next step is ethical leadership. Ethical leadership. So this is the highest level where individuals not only practice ethics but also inspire and guide others to act ethically. Ethical leaders influence organizational culture by embedding ethical principles into practices, policies, and the behavior of their teams. Example. So as the professional grows into leadership role, as the professional, so this is another level. Okay, so like he progresses. Now this example, we consider it here, and then as he progresses into the career, what he would do. So here he showed the courage and he reported it, and then of course the ethics committee would have taken some action to maintain the ethical practices. Now what this person would do as he grows into the further role, so as the professional grows into the leadership role, he will implement what? So he will take stand now to guide others, to influence others. He implements strict guidelines for ethical advertising. Okay. So He implements strict guidelines for ethical advertising. He introduces a review process to verify that all marketing materials are truthful and transparent. He also conducts workshops to train his team on ethical marketing practices and celebrate team members who prioritize ethics in their work. This approach influences the company culture and builds trust with customers. So this is about showing leadership qualities ethically. I'll just zoom out a little. Please go through the example. Let me know when you want me to scroll down. Scroll down. All right. Let me know when you're done. Take your time, no hurry. Done? Good to go. All right. So now let's come to the book and read it from there. You'll be able to understand it better. So Albright's ethical development model, it unfolds in 4 progressive levels. First is ethical personal understanding. This is foundation level. It recognizes the distinction between right and wrong, grasping basic principles of integrity and empathy. The next is application of ethics to business situations. So the first professional education driven level, that means you're driving the ethics into the organization at a professional level. It involves translating and applying ethical principles to business context. Keep the example in mind, you'll be able to relate to the points better. Then ethical courage. It requires individuals to cultivate ethical strength and moral conviction, especially in questionable situations. The person was being pressured into approving the campaign with some altered images. Then ethical leadership. As you progress, you build upon level 3. As you progress in your career, you build upon this ethical courage. Okay. Ethical leaders inspire others. So he was doing workshops. Ethical leaders inspire others to develop their own ethical awareness. So it's driving the culture in the organization to act ethically. Okay. So I would suggest read the examples first and then you relate better. Then next one, the last model that we have for ethical decision making is IEASB Ethics Education Framework. The International Accounting Education Standard Board, IAESB, is an independent standard setting board of the IFAC. Do you know what IFAC is? Do you know what IFAC is? No, I'll show you. You all, if you are CAs, you all are already members of this. And if you're not, you're becoming an ACCA, you will become a member of this. So the International Federation of Accountants, its IFAC is International Federation of Accountants, it's the global organization for the accountancy profession. It was founded in 1977 and it currently has 180 members and associates in different jurisdictions. And let me show you. So this is what we are discussing right now. So it has got some boards and we are currently talking about ethics standard board. Okay. So there's a list actually. I was thinking of showing a list. Yeah, this is what should it be. ICAI. So ICAI. So basically you are being a chartered accountant, you are a member of the ICAI and ICAI is a member of IFAC. Okay. Being CA and ACCA also should be here. Yeah, ACCA. So all of these organizations, they are members of the IFAC. ICMAI, then you might know this. This also you might have heard of. No, not this one, sorry, it's Iranian. And then CMA, you would have heard of, right? AICPA. These are all members of IFAC. So you are a part of IFAC being professional accountants. All right, coming back. So the International Accounting Education Standard Board is an independent standard setting board of the IFAC. So the ethics education framework as developed by the IESB is a 4-stage. Again, this is also a 4-stage learning continuum to be applied by all professional accountants throughout their careers. Okay. Now I'll cover this also with some examples here. Let's come to Excel. So the IASB Ethics Education Framework, developed by the International Accounting Education Standard Board of IFAC, provides a structure for ethical decision making and ethical development in the accounting and business professions. It comprises four components organized cyclically to emphasize continuous improvement and reflection. So I can just copy and paste this here, the diagram. Hmm. Okay, I'll just keep it here. So the components are these components are number one, enhancing ethics knowledge, developing ethical sensitivity, improving ethical judgment, and maintaining ongoing commitment to ethical behavior. Okay. So starting with enhancing ethics knowledge. Enhancing ethics knowledge. This stage focuses on acquiring a foundational understanding of ethical principles, framework, and theories. It emphasizes learning ethical standards, professional codes of conduct, and societal expectation. You all must have studied it in your CA, and you would study this in ACCA also. There is a professional code of conduct that you need to adhere to. So this is the foundational understanding of the ethical principles. Okay. So example, a newly hired accountant undergoes ethics training as part of their onboarding process. They learn about he learns about concepts like independence, integrity, confidentiality, and the professional code of ethics for accountants. For instance, he comes to understand he comes to understand that accepting gifts from clients could compromise objectivity. Okay, that you're not being objective in your work if you're accepting gifts from clients. So that is enhancing the ethics knowledge. Then, second is developing ethical sensitivity. That's the second stage. The ethical sensitivity, it involves recognizing ethical dilemmas and understanding how actions can impact others. So it requires the ability to empathize and identify stakeholders who might be affected by decisions. So while working on a financial report, the accountant notices that his supervisor wants to delay recognizing a significant expense to improve the company's short-term financial performance. So the accountant identifies the situation as a potential ethical dilemma, understanding that stakeholders such as investors and regulators could be misled by such action. So he realizes that, okay, this is something sort of a dilemma. Because of this action, the regulators and investors could get impacted because you're misleading them by delaying a significant expense. Okay, so this is developing ethical sensitivity. Then the third step, improving ethical judgment. Improving ethical judgment. This stage emphasizes applying ethical reasoning to evaluate options and make decisions in complex real world situations. So you're applying ethical reasoning to evaluate the options and make the decisions in complex real world situations. It involves weighing various factors such as ethical principles, professional responsibilities, and legal requirements. For example, the accountant evaluates the dilemma of delaying the expense recognition. Using ethical reasoning, he concludes that this action would violate the principle of fairness and transparency in financial reporting. He decides to report the expense immediately, even though it might affect short-term profitability. Okay, so he is exercising judgment here. And last step, maintaining ongoing commitment to ethical behavior. The final stage focuses on fostering a continuous commitment to ethical behavior and professionalism. It emphasizes reflecting on past decisions, learning from them, and embedding ethics into daily practices. So, example, so after addressing the expense recognition issue, the accountant shares his experience with colleagues and participates in ongoing professional development workshops. He also advocates for stronger internal controls within their organization to prevent future ethical challenges. This is a comprehensive example for you all to understand the framework. So there is one very important thing that you would observe here. I'll note it down and then bring you back to the book to relate this. The framework is put like in a circular diagram. It's a cyclical nature that they want to display about the framework. And what does it mean? So cyclical nature of the framework The framework emphasizes that ethical decision making is not a one time activity. It's not just once that you have to do it, but a continuous process. Each stage involves periodic review and revision to adapt to new challenges and ensure ethical principles remain central to professional practice. Example, let's cover this here. The accountant. The accountant might revisit his ethics knowledge when new accounting standards or regulations are introduced, review ethical sensitivities when encountering a novel situation, and refine his judgment and commitment through feedback and reflection. So, this is the entire framework. And now zoom out so that you can view it fully. Let me know when you want me to scroll down. Go through it, let me know. Go slow, no hurry. Take your time in absorbing what is happening in each of these models. You're able to read now. I've zoomed out, so I hope you're able to read. Let me know if there is an issue. Let me know if you want me to scroll down, okay? These models are very important because these have been newly added in the syllabus. It was not there earlier. So make sure you understand it completely. That's why I've put so many examples. Done? All right. I'll give you one more comprehensive example just to tie it up together. An auditor working on a client's accounts discovers irregularities suggesting potential fraud. So, using the framework, so an auditor working on a client's account discovers irregularities suggesting potential fraud. So now let's see how this model can be implemented. Enhancing ethics knowledge. So they understand, okay? So he understands the standard requiring auditors to report material fraud. So developing ethical sensitivity. He recognizes the potential harm to stakeholders if the fraud goes unreported. Then step 3 is improving ethical judgment. He assesses their options. He assesses his options and decides to escalate the issue internally and inform the audit committee. He reflects on this experience. He reflects on the experience and proposes better fraud protection and proposes better fraud detection process in future audits. So by cycling through these stages, regularly performing these steps, professionals ensure they uphold ethics in every aspect of their work. So this was just a short and sweet example which summarizes all the steps. Please let me know if it's fine. The example which we have covered now. Go through it. Let me know. If it's clear, if not, let me know. Clear? All right. Now with this, let's come to the book and read through the steps. Now it will seem much simpler. So this is the model, and that's what I wanted to show, that it's in a cyclical format.
Okay. So ethical knowledge, obtaining an understanding of the fundamental theories and principles of ethics, virtues, and individual moral development. Ethical sensitivity, applying the knowledge to the work environment to enable ethical threats to be recognized. An ethical judgment is applying knowledge and sensitivity to form reasoned and well informed decision. And ethical behavior, continuously believing in, applying, and acting on ethical principles. So these are the four steps. We have covered that with two examples. I hope it is clear now. You should be able to relate the example and understand the points better. Okay, is it clear, everyone? All the three models, very, very important. That's why I've covered it with so many examples. REST's model, the Albright's ethical development model, and third is IESB's ethics foundation framework. Okay. And on that note, let us take a break, and post the break, we will continue with this. Okay. So refresh yourself and be back. We'll continue. Hello, everyone. Welcome back from the break. Let's continue our discussion. So professional accountants need to cultivate ability to recognize ethical threats or issues effectively, and awareness of ethical alternatives. So be conscious of alternative courses of action that lead to ethical solutions. So rather than acting unethically, you should have the capability to find out ethical alternatives. Then understanding of stakeholder effects. Understand the impact of each alternative on stakeholders. So developing these skills enhances professional judgment by applying ethical theories, acknowledging social responsibilities, adhering to professional conduct codes, and utilizing ethical decision-making models. Okay. Now, ethical decision-making models, the issues addressed. In ethics, addressing two key issues is crucial: right motive and right action. So, what is the correct motive behind the action that needs to be identified? And right action, deciding on the appropriate course of action. So, ethical decision making models provide systematic analysis, ensuring clear judgment, transparent reasoning, and justifiable actions in resolving ethical dilemmas. Okay, so now these are furthermore ethical decision making models that we have in the curriculum. So we will cover them again in the same way like we did the other models. So next is Tucker's 5-question model. So first, what is the Tucker's 5-question model? The Tucker's 5-question model is a framework used in ethical decision making to evaluate the moral and practical implications of a business decision. It encourages organization to consider the impact of their actions on various stakeholders. The model consists of the following 5 questions. Number 1, is it profitable? Is it profitable? This question assesses the financial viability of the decision. Okay, so profitability is critical for long-term survival and growth of the organization. So, example. Example. So the company, 1 second. Yeah. A fast food chain is deciding whether to introduce a plant-based burger. Okay, so for catering to the health conscious consumers. So a fast food company is considering introducing a plant-based burger. So what it does is the company conducts a market analysis. The company conducts a market analysis and finds increasing consumer interest in plant-based diets. Profit projections show potential for a 15% revenue growth in urban markets where demand is higher. So this is the way in which we can address this question. Is it profitable? Okay. Or 1 second, I'll change this example slightly. This one is better. So company considers switching to sustainable packaging. Okay. A company is considering switching to sustainable packaging. While initially more expensive, a profitability analysis might show long-term cost saving due to reduced waste and increased customer loyalty. Okay. Next. Second question that the model asks is it legal? Is it legal? So this question ensures that the decision complies with laws and regulations. Legal violations can lead to fines, reputational damage, and operational disruptions. Okay. So example. A marketing team plans a promotional campaign. They need to verify that their claims about the product adhere to advertising laws to avoid lawsuits. So this is how you will ensure that the decision is within the legal ambit. And then third question is Is it fair? The third question is it fair? So this involves evaluating whether the decision equitably considers the interests of customers, employees, shareholders, suppliers, and the community as in general. Okay. So, example, if a company decides to reduce employee benefit costs to cut costs, it should weigh the impact on employee morale versus the shareholder value it is creating by reducing the costs. The next question is, one second. Okay. So next question is it right? So this question assesses the moral and ethical acceptability of the decision. It often reflects the company's values and societal norms. So example, a food company deciding whether to use a controversial additive, even if legal, it might be deemed unethical if it harms consumers' health in the long run. So this is how you decide whether it is right or not. And is it sustainable? Is it sustainable? So this question looks at the This question looks at the environmental, social, and long term viability of the decision. Sustainability addresses the impact on future generations and the Earth's resources. And natural resources. So, is it sustainable? That's how you consider that. Example. Example. A fashion brand considering using cheaper but environmentally harmful synthetic materials. Opting for sustainable alternatives aligns with this question even if it increases the cost. Okay. So, let's go through it now. Go through it in detail. Yeah. Please go through the model's example here. So this model is a framework. So you have to get answers in yes to all the questions. Then only a decision will be considered ethical. Okay, so that's how the model is structured. So Tucker's 5-question model, read through it. It's a framework used in ethical decision making to evaluate the moral and practical implications of a business decision. Read through it and let me know if it's fine. And let me know when you want me to scroll down. Clear, everyone? Clear? So let me give you one more comprehensive example to sum it up. So a tech company is launching a new smartphone. First one is it profitable? The product has a high profit margin and strong market demand in ensuring financial success. Then, is it legal? The company ensures compliance with intellectual property laws, data privacy regulations, and safety standards. Then, is it fair? The product is priced affordably for its target market and ensures suppliers and workers are compensated fairly. Then, is it right? The company avoids deceptive marketing tactics and ensures that the product is not harmful to users. And is it sustainable? The smartphone uses recyclable materials and the company has a recycling program for old devices. So, by asking these questions, the company can make a well rounded and ethically sound decision. Tucker's model ensures that businesses balance financial objectives with ethical responsibilities, fostering trust and long term success. So, this is how company should evaluate a decision. Like it should be answerable yes on all the questions. On that note, let's come back to the book and read from there. So the Tucker's model poses 5 questions for assessing the ethicality of a decision. Affirmative answers. So answers with a yes are sought for profitability compared to what? Legality, under which framework? So like here we gave the example for smartphone, like under intellectual property law, safety, security law, whatever. Then fairness, from whose perspective? So you have to consider the different stakeholders. Is it fair to all stakeholders? Rightness, is it right that it is not harming anyone? Then sustainability or environmentally sound. So Tucker's model stimulates debate on conflicting ethical approaches, stakeholder perspectives, and sustainability. It is particularly apt for organizational problems, fostering discussions over professional or individual situations. So we have one more example here, Flipkart. A major e-commerce platform collects vast amount of user data to personalize shopping experiences and target advertising. Is it profitable? Personalized ads and recommendation often increase revenue, but user privacy concerns could affect customer trust and sales. Is it legal? India's Personal Data Protection Bill outlines user rights and data sharing limitations, impacting how Flipkart can collect and utilize customer data. Is it fair? Algorithms could create unequal user experience or price discrimination based on demographics and shopping habits, raising concerns about fairness and transparency. Is it right? The ethical implications of manipulating user behavior through targeted advertising and nudges should be considered, balancing marketing strategies with user autonomy. That means user is able to exercise decision. Is it sustainable? Building trust and transparency into data collection and usage practices can create a more sustainable and ethical business model in the long run. Okay. So that's another example. Now, Tucker's model question. Your company owns a number of large hotels in various major cities of the UK. The real estate assessor in London offers for a fee to underestimate the value of your building, and so you'll save substantial annual taxes based on property value. This is a common practice in the region. Okay. This is a case of bribery. Since all 5 questions in this model must be answered in the affirmative, the payment is not defensible. You cannot defend this payment which you're making. Can you make the payment to this person? No. It will be considered illegal. It is unethical. It is not fair to the wider society that the burden of evaded tax should be borne by others. in order to provide the services and facilities for which tax is raised. Nor can it be right, that is just, that others should suffer a deterioration in or lack of services as a result of underfunding. That is considered a common practice does not make it acceptable. Just because it is common practice, it doesn't mean that it is right. Just because everyone is doing it doesn't mean it is right. It is not sustainable in that a vicious circle is created of increasing levies which are increasingly evaded. The environment may be harmed. So, for example, vital services, the provision of clean water may be compromised. If charges then have to be made for services such as waste disposal because they're not taxes enough to fund the service, environmentally damaging practices, illegal dumping are likely to increase. So this type of a situation, whenever you're facing a dilemma, ethical dilemma, you can use the Tucker's 5 model question approach. If only you're getting the answer and yes to all the questions, then you can consider the decision to be ethical. Otherwise, it is an unethical decision that you're going to make. So ACCA, ethical conflict resolution. So ACCA also has a code of ethics that you should know the facts, identify ethical issues, stick to fundamental principles, use established procedures, predict outcomes of actions, think about alternative actions, like what can you do to make it an ethical solution, talk to others, like an ethics partner or audit committee. If needed, consult legal advisors or ACCA without breaking the confidentiality. And if the conflict still persists, you should consider distancing yourself from the matter. So this is the ethics code of ethics by ACCA, what you should do when you're facing an ethical dilemma. Okay, this one is pretty simple. Now, agency issues and stakeholder conflicts. Management must swiftly address conflicts and agency issues to safeguard the effective implementation of the organization's ethical framework, preventing potential damaging public debates. So, agency issues. In a publicly traded company with a significant separation of ownership and control, agency issues can notably influence the ethical framework. You can apply any model. There's no such bifurcation that this model will apply in this situation. Whatever is applicable, you can apply. These are different models which address the same concept, that if you are facing an ethical dilemma, what you should do. Okay, any model can be applied. In exam, what to do? In exam, they will specify whichever model that they want to apply. Or if they're not specifying, they will give you the elements. So for that, you have to know the models by heart, that they will give you the elements. So for example, they will give the question in such a way that all the 5 questions of Tucker's 5-question model will get addressed. So then you have to identify from the hints given in the question. Mostly they will specify. If they don't, they will give the data in the way that is able to address only one model. Okay, Nikhil? In a publicly traded company with a significant separation of ownership and control, agency issues can notably influence the ethical framework. Directors and shareholders face differing ethical positions because scrutiny of directors. Directors' ethical conduct is intensely scrutinized by the public and investigative journalists, risking serious damage to personal reputation in case there is an alleged wrongdoing. Then shareholders' limited responsibility. Shareholders detached from day-to-day operations are less easily held responsible for any ethical lapses. Moreover, institutional investors holding the majority of shares have diversified portfolios across multiple companies. So what it is saying is that if any wrongdoing is found, it is the directors who have to bear the consequences, because anyways the shareholders are detached from day-to-day operations. So company directors and the entire workforce often adopt a cautious, sometimes even paranoid approach to ethics due to the close linkage between their personal reputation. It is always the directors who get caught, and that of the company. In contrast, institutional investors, that is the shareholders, they may adopt a more relaxed stance as they are shielded from personal scrutiny and typically hold a diversified portfolio. So if directors face pressure from shareholders to relax ethical guidelines, effective response may include quoting relevant legislation. So citing applicable laws with penalties for contravention, such as Foreign Corrupt Practices Act or for US registered companies prohibiting bribes globally. So shareholders may have a relaxed approach because they have a diversified portfolio and they're shielded. So when they're putting pressure on the directors, what can directors do? Directors can quote that, okay, this is not allowed as per this act. Then engaging ethical investment funds. So encouraging ethical investment funds to invest in the company, aligning their ethical stance more closely with that of the director. So they will look out for investors who have an ethical stance. So while shareholders hold a pivotal role, potential conflicts with other groups should be acknowledged. Consumer impact. Consumers may boycott products if manufactured in exploitative conditions. Mitigation may involve subcontracting manufacturing, but reputational risk remains. Okay. Then government security. Governments may act against businesses using aggressive tax avoidance. Uh, Recent examples include proposal to tackle promoters of such schemes, allowing authorities to petition the court to wind up companies engaged in tax avoidance. So you cannot do tax avoidance activities because then you will get caught in legal cases. So that completes our ethical decision making topic. And next we move to the topic of sustainability. Very important. Very important and a new age topic which has become hot topic in a lot of corporates. So sustainability, it is a dynamic process aligning resource use. One second. Yeah. So dynamic process aligning resources use, investments, technology and institutions with current and future needs. What do you understand by sustainability? So you might have heard about that common definition. Let's put that in Excel here. So sustainability refers to the ability to meet the present needs without compromising the ability of the future generations to meet their own needs. So you would have heard this definition definitely. So it focuses on a balance between economic growth, environmental protection, and social well-being, ensuring that development is enduring, that is sustainable and inclusive. Okay. So corporate sustainability. Business approach creating long-term shareholder value by addressing economic, environment, and social opportunities and risks. Let me break it down here for you. So there are three pillars of sustainability. Three pillars of sustainability. One is environmental sustainability. So it talks about protecting natural resources and ecosystems, then reducing pollution and waste, promoting renewable energy and sustainable materials. Next is economic sustainability. So ensuring financial viability without exploiting resources unsustainability. So it is there. I mean, you are doing the work with financial viability, yes, but you're not exploiting resources and you're creating jobs and fostering innovation while maintaining long-term profitability. So you're thinking from financial point of view also. And the third pillar of sustainability is social sustainability. So it's about promoting equity, social justice, and fair labor practices, and improving living conditions and supporting community well-being. So you are thinking from social point of view also. These are the three pillars. So let me tell you this with an example here. So a coffee company wants to grow its business while ensuring its operations are sustainable. So first we have so what will it do for that? Environmental sustainability, what will the company do? The company sources coffee beans. The company sources coffee beans from farms practicing organic farming so that the practices are environmentally friendly. It introduces biodegradable coffee packaging to reduce plastic waste. And it implements water saving techniques in its production processes. So this is what a company can do, a coffee company can do for being environmentally sustainable. Then what can it do to be economically sustainable? So the company invests in its farmers by providing fair trade prices, ensuring farmers earn a sustainable livelihood. And it uses cost efficient renewable energy to power its manufacturing plant. Cost efficient renewable energy to power its manufacturing plant. So that gives the company economic sustainability and social sustainability. So the company funds education and healthcare program for farming community. It builds long-term relationship with suppliers, fostering trust and collaboration. And it encourages diversity and inclusivity. Can you give me an example of diversity and inclusion? It's commonly used term now in corporates. I'm sure you would be aware about it. That it encourages diversity and inclusion in its hiring practices. So basically, having women in the company, that's also considered as a part of diversity and inclusion candidate. Okay. So this is an example. Please let me know if sustainability and its three pillars, if it is clear to you, I'll zoom out, take a look at it. Go through it. Let me know if you have any doubt. So mostly questions will be around sustainability and they will give you a scenario that the company is engaged in these types of practices. And then you have to make a commentary on whether these practices are environmentally, ethically, and socially sustainable. So it is possible something that they are doing is environmentally sustainable, but not socially sustainable. So you will have to first, do the discussion on these three grounds and then classify them and conclude whether it is sustainable or not that way. So they'll give you a scenario because as I showed you yesterday, the questions are going to be scenario based. So you'll have to pick up the data from the question and then accordingly discuss on these lines. Let me know when it's good to go ahead. Clear? All right. So then let's come back to the book and understand from here. So now sustainability as a point of view is clear. Like what you should do is should be enduring. That's something which you can continue to do in the long run. So corporate sustainability, business approach. So we discussed the three pillars. So it's a part of corporate sustainability. That is what is relevant for you anyways. So business approach, creating long-term shareholder value by addressing economic, environmental, and social opportunities and risks. Sustainable development is development meeting the needs of the present without compromising the future generations' ability to meet their own needs. And sustainable finance, considering ESG factors in financial sector decisions for making long-term investments in sustainable activities. So examples of sustainable development include use existing buildings instead of new construction, build with eco-friendly designs, minimize impacts on local residents, protect native plants and wildlife, shift to renewable energy like solar and wind, control and clean up pollution, and develop on previously used sites, leaving untouched, undeveloped land. So you don't get into new land encroachments. You continue to develop on previously used land sites. Okay. So next, as I was telling you, ESG, a hot topic. So ESG, environmental, social, and governance investing prioritizes ESG factors and performance alongside profits, emphasizing a long-term outlook over short-term gains. So you have to have a long-term view. So it aims to balance financial returns with environmental and social responsibility, providing a more comprehensive risk analysis for informed decision making. Okay. So what are the three different criteria of ESG? First is environmental. ESG criteria for the environment assesses an organization's environmental risks and impact. This includes climate change, water security, environmental health, waste management, and biodiversity loss. Okay. So interconnected environmental risks can be effectively managed with a proactive approach, going beyond the minimum standard. That means you do not do the bare minimum, you go beyond that. So organizations can enhance their ESG ratings by taking actions that actively contribute to environmental improvement. Business leaders who recognize the value of the physical environment and natural resources strategically pursue business practices that preserve these assets for future generations. So it's quite simple. Then we have social ESG criteria. It focuses on an organization's relationship with various stakeholders, aiming to enhance overall social well-being. So this includes addressing inequalities, upholding human rights, and ensuring worker and community health and safety. So by fostering inclusive, fair, and positive operations, organizations contribute to thriving communities. Social criteria span from executive offices to supply chain factories, leveraging employee policies, benefits, due diligence, and supplier contracts to embed social values. So even I've seen this practically as well. There are contracts with the suppliers, which includes that you will be fair in your practices. There are clauses in the agreement now. So organizations exceeding minimum rights requirements can cultivate a supportive work culture through flexible conditions, dedicated professional development time, and internal promotion opportunities. So you're socially sustainable. Then governance. The essence of governance in ESG criteria lies in business, leadership, and transparency, being transparent in your ways of working. This encompasses policies related to diverse board of directors, having equitable presentation of women in the in the board of directors, corporate accounting standards, executive compensation, public disclosures, conflicts of interest, and other legal and ethical matters. So, governance extends to policies fostering organizational fairness through internal control systems, preventing illegal activities such as bribery, corruption, and tax evasion. So, that's about ESG. So, we have some examples over here. Let's understand that one by one. So, environmental sustainability, RIL. Alongside renewable energy investments, RIL implements strong corporate governance practices like transparent reporting, independent board oversight, and stakeholder engagement. This ensures accountable and ethical decision making regarding environmental responsibility. So they are they're making investments in renewable energies. Then Tata Motors. The transition to electric vehicles at Motors is accompanied by robust governance policies regarding data privacy, ethical sourcing of materials, and responsible disposal of batteries. This ensures a holistic approach to sustainability. Then we have social sustainability, which we have covered as Godrej Group. So their good and green model integrates social responsibility with good governance. Initiatives like employee engagement programs, ethical supply chain management, and transparent reporting on social impact demonstrate their commitment to responsible practices. Then Akshay Patra Foundation. So their extensive meal program relies on robust governance structures, including independent audits, donor engagement platforms, and risk management processes. This ensures efficient operation and ethical use of resources. So that's how they are being socially responsible. I'm sure you have heard about Akshay Patra Foundation. It provides free meals to the poor. Then governance sustainability, Mahindra and Mahindra. So this leading auto manufacturer established good governance as a core value, implementing clear ethical policies, whistleblower mechanisms. So if you're finding something is not going right in the company, you have a whistleblower policy in the company, and strong anti-corruption measures. So this commitment fosters sustainable decision making and long-term business success. Similarly, we have the example of ITC. So their triple bottom line approach, this is also a topic of the curriculum which we are going to study. So their triple bottom line approach balances economic, environmental, and social responsibility with a strong focus on good governance. Their commitment to transparency, risk management, and stakeholder engagement reinforces their sustainability efforts. So some factors defy easy categorization into ESG as they often have interconnected impacts. So ESG are all interrelated components. For instance, reducing greenhouse gas emissions is crucial for climate change and environment, but it also positively affects community health. So yes, it is important for environment to reduce greenhouse gas emissions, but it is also important for society. So you cannot classify any one factor in just either one of E, S, or G. It is possible that one factor can be classified into society also, into environment also, like the example which is given here. So businesses are now urged to report the financial risks and opportunities associated with ESG factors, recognizing that they are not isolated from a company's bottom line. Okay. So, however, quantifying ESG factors in financial terms can pose challenges for companies. So, it becomes difficult to quantify what is the monetary impact of the ESG factors. So, this is the ESG FY24 quarter 2 update of SBI cards. And you can see that environmental, social, and governance is a part of their reports that they're publishing to the investors. This is an excerpt from one of the reports that they published. So you can see like what they're reporting here. Environment, 5.72 lakh plus trees saved from financial year 18 to financial year 24 till September 23 through paperless communication with customers. Then energy optimization. Higher efficient mechanism introduced in air handling units in corporate office, expected 90 kilowatt hour savings annually. So a CSR initiative to establish 10 TPD material recovery facility, 30 TPD plastic recycling facility and 40 aerowind composters in Patiala with Indian Pollution Control Association for strengthening the waste management system. So this is what SBI cards is doing towards the environment. Then let's see what it is doing towards social. New programs for employee welfare. Webinar on sound healing for employees to enhance wellness. I'm sure those of you who are working, you will also have some sort of employee welfare programs running in your company, and that's part of their ESG requirements. Zumba sessions in our main head office, Gurugram, every week to promote fitness. The nutritionist consultation in-house for employees twice a month to support and promote awareness on healthy diets. So, healthcare initiative for communities, projects taken up with Sri Satya Sai Health and Education Trust to set up a mother and child hospital at Raivala to address the mortality and morbidity rate of children. And under governance, what have they done? Let's see. Regular communication and training for all employees on ethical conduct. So they are training their employees to act ethically in all circumstances. Mandatory annual training on improper payments for all employees. So they are being trained like what type of improper payments could be being made. Then risk awareness week celebrated, sensitizing all employees on data protection. And overview session of the Digital Personal Data Protection Act 2023 conducted for the senior management team of SBI Card. So this is what they're doing to ensure the company is acting ethically. See, company is represented by its management and employees. So if the management and employees are acting ethically through, and how will they act ethically? If they are trained properly. Okay, so that is what SBI Card has done for in creating a governance environment in the company. So that's about ESG. Please let me know if it's fine. Anyone having any doubt? So let's do one thing. Let's summarize in brief for you in Excel.
So ESG stands for environmental, social, and governance, a framework used by organizations and investors to evaluate a company's commitment to sustainable and ethical practices. So it goes beyond traditional financial metrics and assesses how a company interacts with its environment, society, and its internal governance. See, when you think about governance, it should be how the company is acting ethically internally. So this evaluation helps stakeholders make informed decisions about investments, partnerships, and operations. And let me tell you, ESG has become so important that whenever you go for raising funds now for your company, investors ask about this report. Okay, so let's understand each one of the elements. So first we have environmental. Okay, so this dimension, in brief, if I have to tell you, this dimension focuses on a company's impact on natural environment. It evaluates efforts to reduce carbon footprints, conserve resources, and manage environmental risks. I'll show you a very good video on carbon footprint so you understand what it is in detail. It's a very important terminology that you should be aware of. Okay, so it evaluates efforts to reduce carbon footprints, conserve resources, and manage environmental risks. Okay, so example. A company like Tesla emphasizes electric vehicles to reduce reliance on fossil fuels, contributing to lower carbon emissions and environmental sustainability. Second, social. So this pillar examines how So this dimension examines how a company manages relationship with its employees, customers, communities, and other stakeholders. So we have example here. So Unilever has initiatives like improving employee well-being, promoting fair trade, and sourcing sustainable ingredients for their products, impacting both local communities and global stakeholders. So Unilever, you might have heard, in India we have its subsidiary Hindustan Unilever. And then third is governance. Governance. So governance addresses the internal systems and controls used to govern an organization. It ensures transparency, accountability, and ethical decision making. So example, if you ask me.
So Microsoft emphasizes ethical AI development and strong corporate governance policies, ensuring compliance and transparency in decision making. So I've put it in very, very simple words for you over here. Have a look at it. So there are a lot of models that you have to be aware of, and that's what lays down the foundation. So just try to simplify it for you here. Go through it. Let me know if it's okay. Then we'll move to the next aspect. Take your time, read through it properly. Go through it. Clear? All right. So then we will cover the next aspects. Let's do it here only. And then we will move to the book. So the next concept which we are studying, the triple bottom line reporting, it is correlated with ESG. Triple bottom line reporting, TBL, or it's also called 3BL. Okay. So So the triple bottom line TBL framework expands the traditional reporting. See, so far, when we have prepared our financial statements, we have always reported on profits. Correct? Now, there is a new concept called TBL. The TBL framework expands the traditional reporting focus on financial performance to include social and environmental impacts. So it emphasizes that companies should measure their success not just in terms of profit, that is economic, but also how they contribute to people, that is social, and the planet.
Okay, so the three pillars of TBL. The three pillars of TBL. Economic, so it measures traditional financial performance, including revenue, costs, profitability, and overall economic value created. Then next we have social. It evaluates how a company treats its workforce, customers, and communities. It focuses on ethical practices, inclusivity, community engagement, and employee well being. Okay, then environmental. It assesses a company's impact on environment. This includes initiative to reduce carbon emissions, manage waste, and conserve resources and protect ecosystems. Okay, so these are the three pillars of TBL. Let me show you how Tesla reports on these aspects. So Tesla Inc. exemplifies the triple bottom line framework by integrating sustainable and ethical practices across the three dimensions. So first one that we have here is profit. Profit, or you can say economic. revenue growth. So Tesla has reported Tesla has reported over $80 billion in revenue in 2022, driven by its expanding product line, including electric vehicles, battery systems, and solar energy solutions. Then market leadership. So Tesla dominates the EV market, holding a significant share globally due to its innovative products. Okay. Similarly, on social aspects, social aspect. Job creation. So Tesla employs over 100,000. So this is what it is, reporting in terms of social. Okay. Then employee welfare. So while Tesla faced criticism regarding workplace conditions, it has also taken steps to improve employee safety and offer competitive benefits. So this is what it is doing towards the social element of it. And lastly, community engagement. We can also capture one point on customer impact. So community engagement, and before that, customer impact. So Tesla's EV have reshaped consumer perception of sustainable transportation by combining luxury, performance, and eco-friendliness. And community engagement. Initiatives like offering affordable solar panels aim to make So they are into solar panels also. They aim to make renewable energy accessible to households, benefiting local communities. Then, third element, what they have been reporting is the environmental impact. Emission reduction. So Tesla's EV directly reduce reliance on fossil fuels, significantly cutting greenhouse gas emissions compared to traditional vehicles. Then I guess That's about the environmental impact that it is creating. Okay. So this is how Tesla is incorporating this in their reporting mechanism. Now, with this example in mind, let's come back to the book and study this topic from here. The term triple bottom line was coined by John Elkington, co-founder of Sustainability, a business consultancy firm. It serves as an expanded performance measure. So it's just that instead of just traditional profit reporting, you are also reporting on other aspects. So triple bottom line accounting aims to assess corporate performance against economic, social, and environmental benchmarks, allowing for improvement or more comprehensive evaluation. If governance is also included, it becomes quadruple bottom line reporting. So this concept can be seen as both a reporting device, often found in annual reports, and an approach. So we have also seen how SBI cards is reporting on ESG. So it's nothing but a part of TBL. So this concept can be seen as both a reporting device, often found in annual reports, and an approach to enhance decision making and organizational activities. It provides tools and frameworks to consider the economic, environmental, and social implications of decisions, products, operations, and future plans. So, what are the advantages? Let's cover that. Advantages are transparency. It reveals decisions explicitly, considering environmental and social impacts alongside financial considerations. Okay, so it makes the reporting transparent. The investors can understand what the organization is doing towards environment, what is it doing towards society. Then informed decision making. It enables decision makers to quantify trade-offs between various sustainability aspects, aiding more informed choices. Then enhanced stakeholder relationships. It improves relationships with key stakeholders and bolsters risk management through consultation. Then there are commercial benefits to it also. It provides specific advantages in the commercial arena, such as a competitive edge. You are considered more competent if you are reporting on TBL. Then this got repeated, I think. Just please ignore this. Then reputation and brand enhancement. It enhances reputation and brand, potentially attracting and retaining employees with sustainable values. Now, what are the disadvantages of TBL? Lack of standards. There are no standards fixed. So, like you have IFRS for reporting the profits, you do not have set standards for TBL. So, there are very few standards which exist for measuring these effects. Then, usefulness and comparability. Varied disclosure practices result in significant variability in content and quality, affecting usefulness and comparability. Blurred lines. Sometimes there is so little distinction between the economic and financial bottom line that it is often unclear. So just remember that for reporting on economic and social and environmental impact. So that's something we should keep in mind. Then increased reporting costs, adoption increases annual reporting costs, disproportionately affecting smaller entities. And then risk and liability.
Potential exposure to risk and liability concerning the reliability of the report's content, unless audit is made mandatory. So there is risk and liability, like how reliable the report is. It cannot be guaranteed like you can guarantee for the accounting profits. Then potential bias. Voluntary presentation may introduce bias as only favorable information may be included. So indicators simplify complex information in sustainability reporting, making it accessible to stakeholders. Organizations use indicators aligned with their goals, but consistency challenges exist, emphasizing the need for standardized approach. So basically there is a need for standardized reporting in TBL also, like you have for your accounting profits. Then only you can enhance the reliability and usability of the report. Okay, so one thing which I want to capture for you in Excel, let me bring it to that. I got logged out of Zoom. Sorry about that. I think I should be audible now. Please confirm. Yes, okay. So what I was trying to do is to simplify financial profits. So there was a point now that there is this distinction between financial profits and economic profits. So I'm just trying to simplify it here for you in Excel so that you can refer to it later also. Financial profit versus economic profit.
as per TDL. A small table will help you.
So definition, financial profit is a basic normal profit which you have been learned, which you would have calculated so far in your careers. Net earnings calculated from financial activities. Whereas economic profit is the broader economic value which is created for stakeholders and society. Scope, the computation part of economic profit or the social or the environmental aspect is not a part of the syllabus, so we are not going to cover that. But it's important to understand the distinction between the two terminologies. Scope of financial profit is focused on revenues, expenses, and taxes, whereas it includes indirect and long-term impacts on the economy and stakeholders. Then here the stakeholders are primary shareholders and investors. For them, profit is very crucial. And for economic profit, it includes employees, communities, suppliers, and broader society. It's not just the shareholders, but it includes the other key stakeholders also. And sustainability focus, short-term, immediate financial gains, whereas economic profit is from the long-term point of view, which focuses on holistic value creation and economic sustainability. Okay. So this is one thing. And one more thing which I mentioned to you was that carbon footprint video. Let me see. Yes, this is the video. There was one term called carbon footprint. So let's watch this video. Very small and interesting video.
The Simple Show explains the carbon footprint. This is you. You've probably been hearing a lot about climate change and how you should reduce your carbon footprint. But what is that exactly? Just like an actual footprint, it's a mark you leave upon the environment. No, not with your shoes, but with every action that releases carbons. Those are the harmful gases, such as CO2, which are pumped out by burning fossil fuels like oil or gas. The more fuel you use, the bigger your footprint will be. You may think that by driving your car, the only carbons you release come from the engine, but no. Consider the carbons that are emitted just to get fuel into the tank. From the energy needed to extract the oil from underground, the pollution caused by transportation and refinement, to the final delivery to your local petrol station. Not to mention the CO2 released by manufacturing your car in the first place. More than you thought, huh? So unless you live in a cave, you and everything you own has its own carbon footprint. Read a book? Printing and distributing. It uses energy. Brush your teeth, and your utensils will have a history in a factory. Even something as basic as an apple could have traveled hundreds or even thousands of polluting miles to end up in your local supermarket. You see, it's pretty much impossible to leave no carbon footprint behind, but that's no reason to stop trying. Think about your actions and choices, and you'll be able to reduce your personal mark after all. That's how you really put the boot into climate change.
The ground. It just transfers. This is pure carbon. So technically, this is a carbon footprint, right? Well, sort of. In this video, we're going to explain what we really mean by carbon footprint, how it is calculated, why we need to reduce it, and how to reduce it. Okay, let's get drawing. In a previous video, I explained what is our ecological footprint. In a nutshell, it is how much land and water area we need to produce the resources we use and to absorb our waste. Here is a link to that video if you haven't seen it. One resource that we use a lot of is carbon, mostly from the burning of fossil fuels. Now, this is a cute drawing, but truly, this is what fossil fuels extraction looks like nowadays. When we do that, it produces greenhouse gases such as carbon dioxide. There are other greenhouse gases, but to keep it simple and easy to compare, we count it as CO2 equivalent. So part of our ecological footprint is actually our carbon footprint. It is the amount of CO2 equivalent that is released into the atmosphere as a result of our activities. In my case, about half my ecological footprint is carbon, and worldwide it is about 60%. We can also calculate the carbon footprint of the world, a country, a business, an individual, an event, a product, etc. For example, when we travel with a vehicle that burns fossil fuels, it clearly releases carbon into the atmosphere. If I use an electric vehicle, then the question is, how is the electricity produced? In the United States and China, for instance, the two countries with the largest carbon footprint, about 65% of the electricity is produced from fossil fuels. So there is a good chance that even an electric car generates a lot of carbon dioxide. But I'm already getting into how the carbon footprint is calculated. So how do we do that?
So the calculation part is not needed for our syllabus, so skipping that. I hope you got an idea of what carbon footprint is. It's basically about how much carbon dioxide is produced because of the activities that we do. And it's very important to reduce our carbon footprint to have a sustainable environment. Okay. So now I have an activity for you. This is something which you're going to do. The board of directors of Plum Company are discussing whether to adopt a TBL reporting system increasingly used by the company's competitors. The board would like to demonstrate the company's commitment to sustainable development, but is concerned that the cost of TBL reporting. Yeah, I'll share that. Sorry, I think it's already there. One second, I'll update it. I've updated it. It's there in the notes. All right, coming back. So it is increasingly used by the company's competitors. The board would like to demonstrate the company's commitment to sustainable development, but is concerned what the cost of TBL reporting would. They would exceed the benefits, and particularly as TBL reporting is not mandatory for external reporting purposes. So they are just pondering about this. Now explain what TBL reporting involves and how it would help demonstrate Plum's sustainable development. Include examples of measures that can be used in a TBL report. and discuss how producing a TBL report may help management improve the financial performance of the company, providing examples where appropriate. So you want to try this out on your own? Both the parts, you want to try this? Or you want to read through to understand the concept more? Whatever you suggest, we can do. Come on, tell me, let me know, please. Do you want to try this on your own, or should we read it together to understand? You want to do it as homework? Mansi says read it together. All right, let's read it together because as a concept, also TBL is new. So first one is about explain what TBL reporting involves. See, always whenever you see questions like this, break it down. So first part is explain what TBL reporting involves. So let's say the principle of TBL reporting is that corporations' true profits must be measured in terms of a balance between economic, environment, and social factors. So that we have learned now, with no one factor growing at the expense of the others. So the purpose of TBL is that it's not just any one factor is growing, but all the factors should be having a balanced growth. Okay. A corporation's sustainable development is about how these three factors can be combined so that the company builds a reputation as being a good corporate citizen. A corporation that balances the pressures of all the three factors. You always have to have a balanced growth of the three factors. It will enhance the shareholder value by addressing the needs of all its stakeholders and not just the shareholders. However, whereas TBL reporting is a quantitative summary of the corporation's historical performance, sustainable development tends to be forward-looking and qualitative. Okay. So the second part was what? How it would help demonstrate Plum's sustainable development. So now we are introducing sustainable development. Now, economic impact can be measured by considering operating profits, then dependence on imports. See, I told you it's not the same. One is your financial profits. Then you also include dependence on imports and the extent to which local economy is supported by purchasing locally produced goods and services. So what is the wealth that you are creating, not just for the shareholder, but also towards the society? Then social impact, but rest assured, calculation is not a part of your syllabus. So social impact can be measured by considering working conditions, fair pay, using an appropriate labor force and not child labor. Okay, so you can include the examples. We have already covered it in length in our discussion. And then environmental impact can be measured by considering the company's ecological footprint, emissions to air, water and soil, use of energy, and water and investments in renewable resources. Okay. So ideally, the company's economic, social, and environmental performance should be benchmarked against that of the competitors or against the industry, national, or global leader in sustainable development. So I told you, remember, you have to write in short paragraphs. And see, you always try to keep this in mind that you have to address both the parts of the requirement. So explain what TBL reporting involves was just first part. So that was covered in the 2 paragraphs here. And then it said how it would help to demonstrate Plum's sustainable development. So then you introduce the element of sustainable development, that it is a forward-looking and a qualitative aspect. And then you talked about economic, social, and environmental impact, right? So this is how you can write the answer here. And next one is discuss how producing a TBL report may help management improve the financial performance of the company by providing examples where appropriate. So for TBL reporting to improve the company's financial performance, the benefits that accrue from the assessment and production of a TBL report must exceed the cost of undertaking the report. So the benefits that you're getting out of doing this assessment of profits into economic, environmental, and social, it should exceed the cost of preparing that report. The cost of producing the report should be relatively easy to measure. However, The benefits may be difficult to measure and may take place over a longer time period. So cost you can anyways find out by how much you're paying to the specialist. But what are the benefits that are coming out of TBL, that will show in times to come. It doesn't accrue immediately. So what are the examples in which the company may benefit financially are focusing on and reporting the company's environmental and social impact may build reputation. And this will attract you customers who are, conscious about these elements. Reducing the company's environmental impact may reduce the risk of paying fines for environmental damage. So you, as we said that, okay, we have to do a cost benefit analysis of doing a TBL. Cost is okay, benefit is difficult to quantify. So now we are listing down what all are the examples of the benefits that can accrue because of TBL. Then consideration and improvement of working standards and consulting employees as part of this process may help in retaining. You're reducing attrition. I yesterday explained to you that attrition is not good for the company. You have to maintain a contented workforce. I discussed this today also. Now, are you able to all connect the dots that having a contented workforce can be enabled through sustainability and therefore TBL? So it may, where was I? Yeah, it may help in retaining and attracting high caliber employees. Then better communication with stakeholders may result in improvements in governance procedures. This in turn should lead to a reduction in agency costs. What are agency costs? When directors are not acting in the best interest of the shareholders, and that leads to some sort of, misalignment of the goals. So that if you are following TBL, then there will be a better communication with the stakeholders. There will be better governance procedures, more transparency in terms of reporting, and that will help to align the goals of the directors and the shareholders. Reducing the carbon footprint. I showed you the video on carbon footprint. So reducing the carbon footprint may be achieved by switching from importing materials to using local suppliers. So this may reduce the risk of stockouts and also boost the company's reputation through supporting the local economy. And monitoring and reporting on the performance of employees and managers as part of the assessment of economic and social factors may help to identify areas where work can be done more effectively and efficiently. So now I hope the concept of TBL holistically is clear to you and how it correlates with a company's financial performance, how it can improve the financial benefits of a company. It's a very good question. Keep this marked because TBL as such as a topic is new in the curriculum. So this type of a question can come. See, no one is asking you to repeat the parts of TBL. It's just how you correlate them with the scenario and present your points. So mark this as an important topic. Is it clear? Please let me know. Yes? All right. One second. Okay. So risk management. So yesterday I told you that you will be engaged in 3 types of decisions being in a finance profile. And what are they? It's investing decision, it's financing decision, dividend decision. And to cover them all, we have risk management. Okay. So what is risk? Risk is the variability of returns. That means something is not happening the way you want it to. So risk is the variability of returns, both positive and negative. It's not just that risk is negative. Risk is the variability of returns, both positive and negative. It can be quantified using statistical measures such as probabilities, standard deviations, and correlations between different returns. So the theory is risk management involves decisions to alter volatility, such as swapping variable interest rates for fixed rates.
just to tell you, remember I was telling you yesterday that if you are taking a loan, okay, you have to do risk management. How? So let's say you have a variable rate loan. Ma'am, what is a variable rate loan? When you have to pay interest at variable rate, that means it is dependent on a market rate. In India, you might have heard the term MCLR, or otherwise also you would have heard terms like LIBOR. So these are market lending rates, and the banks charge a certain margin on it. So MCLR plus 2% is the interest which bank is going to charge you. So in effect, what happens is every time this market rate changes, this MCLR changes, your interest outflow will change. Now with that, read the same sentence again. Risk management involves decision to alter return volatility, such as swapping variable interest rates. So swap is a hedging technique which we will learn in the chapter later. So it is, how do you manage this volatility? By swapping the variable interest rate loan for a fixed rate loan. I'm not going into the details of it here, but just to give you context, what is a variable and what is a fixed rate loan? Fixed rate loan is whatever the market rate may be, you have to pay interest at 9%, 10%, 11%, whatever that is that you're negotiating with the bank. Okay. So risk management involves decisions to alter return volatility, such as swapping variable interest rates for fixed rates. It's justified if it enhances the company's value by either increasing future cash flows or reducing the required rate of return, ultimately boosting NPV at a lower cost. Okay, so when you do risk management, you help to boost the profits of the company, and we will learn how to do that in detail. Complete chapters are dedicated to this. So in practice, while reducing an organization's risk exposure is logical, a blanket approach of hedging all risk may not be effective. So it's not like you manage and hedge all the risks which a company is facing. No, you let some risk remain in the company. So why? So a blanket approach of hedging all risk may not be effective for several reasons. Let's understand. A limited long-term protection. Hedging provides short-term but not necessarily long-term protection. Derivative contracts, again, which we will be learning later. So derivative contracts like forwards, futures, and swaps align with long-term trends in the spot market. For instance, an appreciating domestic currency. Just ignore this line for the time being. You won't be able to understand it now, but once we do the currency risk chapter, you will understand. So just ignore this. Don't read it now. What we are doing is there are some contracts like forwards, futures, and swaps. They align with long-term trends in the spot market. So again, these are not very long-term. So hardly for 12 months you can hedge. So there is very limited opportunity to do long-term hedging. You have to do short-term hedging, and therefore a blanket approach is not possible. Just ignore this line for the timing. Later, when you read it after that chapter is over, it will make sense to you. So, cost implications. Hedging involves costs. You have to incur costs to hedge your transaction, encompassing transaction cost of using derivatives and higher salary cost for hiring people who can do such hedging techniques. You know, there are going to be finance professionals who would be experts in doing hedging, and you will have to hire them to hedge the relevant risks. So if you plan to hedge all risks possible, then you'll have to hire a lot of professions, and that will involve costs. Then existing shareholder hedging. Shareholders, particularly listed companies, they often hold diversified portfolios that inherently mitigate various risks. So remember, there is a saying, do not put all your eggs in one basket. Why is it so? Because there should be diversification, and when you do diversification, when you're putting eggs in different baskets, it's possible that any one may break, two may break, fall down. But it's not like all the baskets will fall down at the same time. But there is a higher chance of one basket, if you're putting all your eggs in basket, it falls and all your eggs break. So that is why it is said that as an investor, you do not put all your money in a single stock. You diversify your portfolio, and that's a very rational decision making.
And it is assumed that the shareholders are rational decision makers and they hold diversified portfolio. So coming back to the point, shareholders, particularly in listed companies, hold diversified portfolios and inherently, therefore, mitigate risks. So you mitigate risks by holding a diversified portfolio. So corporate risk management, if we are doing it individually in a company, then it will add costs for the shareholders without any additional benefit for them because their portfolio overall is hedged. And now if individually each company starts doing diversification in some sort or some sort of hedging, then it adds to the costs without giving any substantial benefits as they already have natural protection against certain risks. I will come back to this point of diversification in one of the upcoming chapters. Okay. So then we'll pause here for the day about the need for risk management in theory and in practice. So what have we learned? Risk management is needed. Risk management is needed for protecting the company whenever you're making decisions, investment, then financing or dividend decisions, then you do risk management. Okay. And I've given you one example that when you are having a variable rate loan and you are afraid that interest rates will rise in the future, you may consider swapping it with a fixed rate loan. Again, it will come in the later chapters. Don't stress on it much. You will learn about the practicality of it. And in practice, you cannot hedge all the risks. The reason being, there is limited long-term protection techniques available in the market. Second is, it involves cost. And third is that shareholders would not want to spend additional money on hedging because their portfolios are naturally diversified and therefore hedged. Okay. So we pause here. Okay, so that's about so notes for chapter 1. So what I follow in the classes, once the particular chapter is complete, I share across the notes so that any updates which are done, it gets done and you get the final copy of the notes, because you must have seen I keep adding things when we are discussing some things. So once the chapter is completed next week, I'll share across the notes with you because the chapter is not complete. A few aspects are still left. So once that is done, I'll share across the notes. So I share it with the team. I'll share it with Sandeep and then they upload it on a Google Drive for which you will all get the access. Okay. Okay. And till that time, you can revise from the book. So we have completed till page number 17. So you can revise from there. And notes I will share across once the entire chapter is complete. Okay. Thank you so much for joining in and share across the orientation notes or the exam pattern and all that you can go through because that's done. So I'll share it across. Okay. Thank you so much for joining in today. We'll see you next Saturday. Bye-bye. And please take care of yourselves. Thank you. Bye.